Hey guys, what's up and welcome. In this one we've got 3 videos to take a look at. We've got stocks are clearly the place to be if we get stronger growth, says the professor Jeremy Siegel. Then we have some technical support, some charts we're going to look at on Microsoft, Apple, Meta, and AT&T into earnings. Then we have buy on a tactical basis but be ready to sell in 2024, says Erin Browne. So all of these kind of go together. We'll start with the professor Jeremy Siegel to kick us off. As always guys, if you enjoyed this video, make sure and hit the like button. I thank you for being subscribed, and let's jump into it.
Professor, I think we got your audio back.
Okay,
can you
thank
maybe
you.
start your answer again?
Yeah, right. Well, let's talk about, you listed some very good reasons why yields have risen. If it's stronger growth, what would you rather be in, stocks or bonds? Clearly, stocks are the place to be in if we get stronger growth. And I don't mean just for last quarter. I think the promise of AI is real. This year, our growth is being driven by productivity. We actually have payrolls that are only half as big increase as we had last year, and we had less than 1% GDP growth. And this year, we're going to have well over 2% GDP growth. So
this week, I'm definitely going to be taking a look at Alphabet, Microsoft, Meta, and Amazon. I'll definitely check out most of the earnings, but the ones I'm going to be taking a closer look at, Alphabet, Microsoft, Meta, and Amazon for sure.
So productivity-driven growth, first of all, it brings inflation down. It's good for earnings, but it does drive yields up. Higher real growth, more borrowing, more capital investment. I want to be in stocks and not bonds. Let's talk about the deficit. Suppose the higher yields are driven by the deficit, and that may mean higher inflation, in the future with big deficits. Where would you want to be? Stocks or bonds? You would want to be in stocks. Now, Sarah mentioned Japan. I'm not as convinced. Japan 30 years ago, when its stock market peaked off, was as big as the United States. Now it's a tiny fraction. Its economy and an aging population is declining. Yes, it holds a lot of treasuries, but I don't think Japan is the force that it once was. So I'm not as concerned about Japan as being a source of the reason. But when I take a look at these higher yields, especially driven by productivity, growth, and even if you worry about deficits, listen, I'd rather be in stocks.
I definitely agree with Mr. Siegel, guys. I've always been a stock picker. I always think you can do better in stocks that you pick versus indexes, and definitely versus the bonds. I'm glad Mr. Siegel sees it. He's even recommended, I'm pretty sure at one point, to go 80% equities and 20% bonds, maybe even 100% depending on your age. So we're definitely getting out of an era where bonds are going to be 60-40 or any real meaningful number. I think 80-20, maybe 100-0, depending on if you actually know what you're doing in the market. You can pick some good stocks, guys.
Isn't the geopolitical picture, though, now, Professor, more short-term, right? More acute, more apt to give investors caution?
Right, it does, and these geopolitical problems are usually opportunities to buy if we look back at history. Now, clearly things could get worse in the Middle East before they get better. You are invited to try to time that in the market. Not many people can. What is the most famous saying in stocks? That stocks climb the wall of worry. And when then there's no clouds in the sky, you're buying too high. I really think geopolitical risk is in the long run.
I really like that. I don't think I've ever heard that. It's very interesting. When there's no clouds in the sky, you're definitely buying too high, guys. So in other words, if there's no bad news around, there's nothing to push your stock down, you're probably buying it a little too overpriced. Now, on the other hand, in an economy where we have, like right now, we've got so much worry out. We've got so many clouds in the sky. In history, always been the perfect time to buy. When others are fearful, you get greedy, guys.
Run an opportunity to buy stocks, not to sell stocks.
I think the point that I was trying to make, Professor, on Japan is that not necessarily that it's, an economic headwind. However, it is a trigger for higher rates in the U.S. because we do see that when there's talk of their yield curve control adjustment, then our treasury yields rise, which is all an economic headwind. So I get that you like stocks better than bonds, and we've had pleasantly surprising growth, but now we're facing the fastest tightening cycle that we've seen, this big backup in yields and what that does for financial conditions and for consumer spending, and quantitative easing at the same time. That's the test for growth and for earnings.
I think she means quantitative tightening.
Ultimately, isn't it?
And you meant, I guess, quantitative tightening at the same time.
Yeah.
Yeah, right, at the same time. Right. Certainly, I think these higher yields have been the source of this, 5-6% drop that we've seen in the S&P. But then when I think about, well, is that because of stronger growth? Then that means next quarter, that means next year, earnings are going to be better than they would be otherwise. Don't forget, we talk about stronger real yields, and certainly they have gone up. The 10-year TIPS is 2.5. We have to remember when TIPS came out in 1997, they were 3.5, and within 3 years they were 4.5. So in the long picture, these real yields, although certainly higher than they've been in the last 10, 12 years, are not high in terms of history. And if we have real growth that's the source of these higher yields, I don't think that's a negative for stocks.
He doesn't think real growth will be a negative for stocks, guys. If we can have the Magnificent Seven and many other stocks push through in a market like this, then when is the time to be 60-40 in bonds, guys? I personally never see the time. You're wasting your money getting a less of a return. If you're a good stock picker and want to dive into balance sheets, dive into fundamentals, dive into the actual company and focus on getting good stocks at a good price, you can well beat bonds and treasury yields. All right, now we're going to jump into this week's earnings. They're going to show us a little bit of some support lines and resistant lines on Microsoft, Alphabet, Meta, and AT&T.
Starting with, I guess you could say the granddaddy of them all. That's Microsoft.
That it is. So they all have very similar themes, which I find interesting. But this one I wanted to chart a daily chart. This is where the support is, right at 325. And you'll notice that all of the mega 7 are finding support on moving averages, which I find very important and cognizant to watch. So we're at 325 right now. As long as we hold this from earnings, then we've got upward momentum to 340 and then again to 350. If not, then we are testing this lower level, which is lower of 300.
So you would be bullish on this from what you see?
I would. This is the ample buying opportunity as long as it holds this line. If it does not hold this line, then that's when we flip to bearish.
All right, let's move on to the next one is Alphabet.
Yes. So Google.
That's not saying too much. Yes, we're bullish. Unless it doesn't happen, then we're bearish. It's like, what did you really say?
This one, we are looking at a 13 weekly moving average. This is a longer time frame, and this is honestly my favorite charts. 13 weeks represents 1/4 of prices, so extremely important as we go into earnings season. This is slow.
That's very interesting. A 13-week trend line. I'm gonna have to add that to my charts, guys. Look how it hugs that price movement. 13-week, never even heard of it.
Sloping upwards, which indicates that bullish trend. I want to make sure that that is maintained. That is absolutely imperative. So as long as this level right here around that 132 is maintained, then we are going to still remain bullish. However, if it fails, then we're bearish once more. But if we have positive earnings with that AI story, I'm expecting that, then we can expect 140 and even 150 from all the way over here.
So if it dips below that purple line, if the price action dips below that purple line, that would be the watch out moment.
That would be the watch out moment. These are crucial. It's great. It's at support. We want to make sure that there's supply there. But if it fails and sellers come in which case we're going to flip bearish.
All right, walk me through Meta.
Meta. So Meta is also looking at the 13-week.
Same sort of looking chart, right?
Same chart, which is, I love using the 13-week again because of 1/4 of prices. Right now, same thing. Meta is right at its support line here. If that breaks, then we are looking at here, which is that psychological aspect that we talk about quite a bit. At one point, it teeters between support and resistance constantly. So if this isn't maintained,
so I'm going to drive them crazy. I'm going to walk over here. So
all right, guys, we don't care too much about AT&T. So there's some support and resistance lines on the major channels for the mega cap 7. Now we're going to look at Erin Browne saying buy on a tactical basis, but be ready to sell everything in 2024. Let's see what she's talking about, guys.
On how to position through the quarter and the end of the year. PIMCO's Erin Browne. Welcome back. It's good to see you.
Nice to see you as well, Scott.
What do you make of this market action? I mean, I'll just ask you plain and simple. Have yields peaked?
So I think it's really hard to call the peak in yields. We still have massive Treasury supply, which is coming. I think key gate date is going to be the next Treasury refunding on November 1st. But I think absent that, with term premiums continue to rise, I think you can definitely say that the curve is likely to steepen from here. And it's very hard right now to call the peak in yields.
Are we on recession watch then, or how do you assess that?
I do think that we're heading to a much slower growth environment over the next year. Whether or not we tip over into recession, I think it's a really hard call to make at this point. But I do expect that we're going to see growth slow below potential. We're going to have inflation gradually come down. And I think that the tails for the outcome, are particularly wide right now, which does make uncertainty high and make it a really tough environment to be directionally long equities. Between now and year end, I think it's fine, because of seasonal effects, because, we've sold off recently. I think it's fine to have a little bit of a long going into year end. But as we turn the page into next year, I think those interest rate sensitive sectors of the economy are going to be hit hard. And they've done pretty well year to date. So I think that's really the key area to watch.
Interesting, though. You do think that we could actually rally between now and the end of the year? Because I don't know, the last handful of days as rates, 5% seem to be the line in the sand. If you're going to continue to go above 5%, it's like, okay, well, maybe that's going to upset plans that the Bulls had for a late year run.
I'm interested to hear what she has to say. In my opinion, we can't have rates go over 5% or meaningfully over. We can't have the VIX spike over 20. We can't have earnings be an upset. Any of those three, it's going to be dramatically harder to have this Santa Claus rally. Might even end it.
So I think the market's largely been pricing in higher and higher yields, really for the bulk of 2023 and 2022. And that's why, we've come off pretty significantly over the last 3 months and really in the third quarter with respect to equities. Going into year end, we have an earnings season which is set up optically to look actually pretty decent. We're going to get a lot.
What she means by that is year-over-year comparisons are going to be pretty easy to beat. And most of the mega caps have been flat for about 5 months. So they have two big reasons to go up, a beat on earnings, and they've been stagnant for a little while.
About a third of the S&P reporting this week, but I think you're going to have and hear pretty decent earnings coming off of what continues to be a pretty strong economic environment. So I think for that could set up pretty nicely for a year-end rally. That said, I think what's going to be really key is how companies are indicating for the year ahead. And I think you could see a lot more ambiguity, a lot more uncertainty. So, while I expect that we'll see pretty decent earnings this year, for the rest of this year, I think as we move into the, 2024, the earnings setup is going to be a lot more difficult. So I would say.
So she thinks we're going to beat earnings, but that either they'll give no guidance or bad guidance into 2024. We won't know until we know.
Buy on a tactical basis, but get ready to start to sell as we move into 2024 on what I think is going to be much tougher comps next year.
I'm sorry to step on your toes there. You are a PM over there, portfolio manager. What's your biggest position right now?
Right now, our biggest position is in duration. I mean, we think that duration right now, not too dissimilar from the comments that were made, overnight by some of the tweets we've heard from some of the hedge fund.
We want to know what stock you have the biggest position in. Goodness.
Managers. We think duration is, pretty attractive at these levels, particularly for medium to longer term investors. Mortgages, agency mortgages, just given the sell-off are really cheap versus intrinsic value. So we also think that looks attractive. In equity space, we're long quality, we're long some more defensive assets and short some of the cyclicals, specifically consumer cyclicals like auto.
Okay, so she's specifically not giving individual company names. Guys, we've got a lot of people calling for good earnings this season. We always know when a lot of people are on one side, though, the opposite tends to happen. We have everybody calling for good earnings, but weak guidance into 2024. So that could just mean we blow off the earnings beats and we still sell off, guys. It's going to be pretty hard to put new capital to work in any of these next few weeks. It'll probably start to be a little easier after this week when we have some direction from the mega caps. Like she said, we have almost a third of the weight of the S&P reporting this week, guys. So it's a huge week. As always, I hope you guys enjoyed today's video. If you missed earlier's video, go check that out. I hope you guys have a great rest of your day, and peace.